The untrained trader stares every tick, mistaking movement for opportunity. The professional observes less but understands more. Markets do not reward constant attention, they reward correct timing. Consider the operator who waits through hours of noise for a single test of supply. While the crowd trades every fluctuation, he enters only after confirmation, when demand proves itself and risk is defined. Patience here is not inactivity, it is disciplined judgment. The first lesson every serious operator must learn is that not every movement in price represents opportunity. The market is in motion at all times, yet profitable opportunity appears only at specific moments that are prepared quietly and revealed deliberately. The novice confuses activity with meaning. He believes that because price is moving, something must be done. The professional knows better. He understands that most price fluctuations are nothing more than noise created to facilitate the plans of stronger interests. Price moves for two primary reasons: to absorb orders and to test conditions. During these periods, the market may appear busy, volatile, even exciting, but no real advantage exists for the late observer. These movements are not designed to reward impatience. They are designed to invite it. The public responds emotionally, buying strength and selling weakness, while the informed operator observes calmly, recognizing that the market is merely preparing, not performing. True opportunity emerges only when price acts in harmony with its cause. Before a meaningful advance can occur, stock must be accumulated. Before a significant decline, distribution must take place. These processes require time, deception, and repeated testing. Until this preparation is complete, price movements lack consequence. They may travel far in points, but they do not travel far in meaning. The professional studies this preparation, not the surface action. Consider a trading range that has contained price for weeks. Within this range, price rallies and reactions occur daily. To the untrained eye, each swing appears tradable. To the trained operator, these movements are simply the market feeling for supply and demand. No position of consequence is taken until the range begins to resolve itself, until supply is proven weak or demand is proven strong. Only then does movement transform into opportunity. Selective observation is therefore essential. The operator does not watch price to be entertained. He watches to identify critical moments. These moments appear near the end of accumulation or distribution, at points of support or resistance, or following a test that confirms the absence of opposing force. Everywhere else, price movement is irrelevant. When the market finally moves with purpose, it does so decisively. Volume expands, spread behaves logically, and reactions fail to retrace. This is not coincidence, it is confirmation that the preparatory work has been completed. At such times, the operator acts without hesitation, not because he is bold, but because the market has made its intentions clear. To ignore most movements is not laziness, it is discipline. The market offers countless invitations to act, but only a few invitations to profit. The professional trader survives and prospers by declining the former and waiting patiently for the latter. In doing so, he aligns himself not with motion, but with intent, and it is intent, not activity, that produces consistent results. The second principle of sound trading judgment is that observation must be purposeful, not constant. The market does not reward the trader who watches every fluctuation. It rewards the trader who understands what to watch and when to watch it. Continuous observation without a guiding objective weakens judgment, breeds impatience, and ultimately leads to action where restraint is required. The untrained trader believes that more screen time equals greater insight. In reality, the opposite is often true. By following every minor advance and decline, he becomes emotionally involved with price movement that has no strategic importance. His decisions are shaped by immediacy rather than context. The professional operator, however, limits his observation deliberately. He studies the market in stages, always with a specific purpose in mind, to determine the balance between supply and demand. Purposeful observation begins with market structure. The operator first asks, is the market in preparation or in execution? Is it building a cause through accumulation or distribution, or is it already in a markup or markdown phase? Until this question is answered, detailed observation of short-term movements is not only unnecessary, it is misleading. Without understanding structure, The trader sees motion but not meaning. Once structure is identified, the operator narrows his focus to behavior at critical areas. He observes how price reacts at support and resistance, how volume behaves during rallies and reactions, and whether effort produces proportional result. These observations are not continuous, they are selective. Hours of market activity may be ignored so that a few decisive moments can be studied with clarity. During trading ranges, purposeful observation is especially vital. Within these ranges, price frequently moves in ways designed to confuse and exhaust the public. False breakouts and reversals and exaggerated reactions are common. The professional does not chase these movements. Instead, he observes how the market responds to them. Does supply emerge on rallies? Does demand appear on decline? Are tests being accepted or rejected? These responses reveal far more than the movements themselves. Another critical aspect of purposeful observation is detachment. The operator maintains distance, both emotional and physical, from the market when nothing of importance is occurring. He is not compelled to act simply because the market is open. By stepping back, he preserves objectivity and avoids the subtle pressure to manufacture trades where none exist. When purposeful observation is practiced correctly, the market begins to speak more clearly. Patterns become simpler, not more complex. The operator recognizes that most of the time the correct action is to wait. Observation then becomes a tool for preparation rather than participation. When the moment of significance arrives, when supply is exhausted or demand asserts itself, the professional is ready. His observation sharpens, his decisions are decisive, and his execution is calm. This readiness is not the result of constant watching, but of selective, intelligent study. The market rewards this approach by revealing its intentions to those disciplined enough to listen, and only when it truly speaks. The third and most decisive principle in intelligent speculation is that confirmation is the market's signature. Without it, all opinions, forecasts, and apparent signals remain unproven assumptions. The market does not ask the trader to believe, it demands that he wait until proof is given. The professional operator never anticipates what the market should do, he responds only to what it has demonstrated. The public trader is drawn to prediction. He attempts to buy the bottom tick or sell the top tick, believing that early entry produces greater profit. In reality, early entry most often produces greater loss. Acting without confirmation means acting without evidence. The market frequently appears ready to move long before it is prepared to do so. These premature movements are designed to mislead, to invite commitment before conditions are favorable. Confirmation occurs when price, volume, and behavior align to verify a conclusion. A breakout, for example, has no value by itself. It becomes meaningful only when it is supported by expanding effort, constructive follow-through, and an absence of opposing force. Without these elements, the movement is merely a test, often a test designed to trap the eager and reward the patient. Within accumulation, confirmation reveals itself through successful tests. Price declines into an area of prior support, yet volume diminishes and downward progress is limited. When price advances afterward with improved spread and demand, the market is not suggesting, it is confirming. This sequence tells the operator that supply has been absorbed and that stronger interests are now in control. Likewise, in distribution, confirmation appears when rallies fail. Price may advance on reduced demand, spreads narrow, and reactions grow deeper. When support levels fail after repeated testing, the market confirms that distribution has been completed. Only then does the professional act, knowing that the preparatory work has already been done. Confirmation also serves a vital role in risk control. By waiting for evidence, the operator can define risk precisely. Entries are made near logical levels where invalidation is clear. Stops are placed not in hope, but in logic. The trader who waits for confirmation sacrifices a small portion of potential profit in exchange for a substantial increase in probability, and this trade-off is the foundation of consistency. It must be understood that confirmation does not arrive frequently. The market may offer only a handful of confirmed opportunities in a given period. This scarcity is intentional. The market is structured to reward patience and punish haste. The operator accepts this reality willingly, knowing that his edge lies not in frequency but in selectivity. When confirmation finally appears, it brings clarity. Doubt disappears, emotional conflict subsides, and execution becomes straightforward. The trader is no longer guessing, he is responding to verified conditions. In this way, confirmation acts as the market signature on a contract. Once signed, the professional participates with confidence, discipline, and restraint, knowing that the market itself has authorized his action. The fourth principle of sound market conduct is that waiting is a position, not a weakness. To the inexperienced trader, inactivity feels unproductive, even negligent. He equates success with constant participation and measures effort by the number of trades taken. The professional operator understands that restraint is not the absence of strategy, it is often the strategy itself. Markets spend far more time preparing than performing. Accumulation and distribution unfold slowly, deliberately, and often deceptively. During these periods, price action may appear active, but opportunity is scarce. The untrained trader attempts to force profits from this environment, entering position without advantage and surrendering capital through a series of small, unnecessary losses. The professional, by contrast, remains patient. He recognizes that capital preserved during uncertain conditions becomes a weapon during decisive moments. Waiting requires conviction in method, in observation, and in probability. Without a clear plan, waiting feels uncomfortable. With a sound plan, it becomes natural. The operator waits not because he is unsure, but because he is certain that the market has not yet revealed its intention. He understands that premature action is more dangerous than delayed action. This discipline is especially important near areas of apparent opportunity. The market often approaches support or resistance in a manner that tempts participation. Price may pause, volume may contract, and commentators may declare a turning point. Without confirmation, these appearances are unreliable. The professional does not act on appearances, he waits for evidence. By doing so, he avoids being drawn into positions during tests, false moves, and temporary imbalances. Waiting also protects the trader from emotional erosion. Each unnecessary trade chips away at confidence, focus, and objectivity. Over time, this erosion leads to impulsive decisions and inconsistent execution. But remaining flat during unclear conditions, the operator maintains mental clarity. He stays aligned with his rules rather than reacting to the market's constant provocation. It must be emphasized that waiting is not passive observation without purpose. It is active restraint guided by analysis. The operator monitors structure, studies behavior, and notes changes in effort and result. He is engaged intellectually, even while remaining inactive financially. This distinction separates the professional from the spectator. When the moment of opportunity finally arrives, it is unmistakable. The market moves with authority, confirmation is evident, and risk can be clearly defined. Because the operator has not exhausted himself through overtrading, he is fully prepared to act decisively. His execution is calm, his position size is appropriate, and his confidence is intact. The market does not compensate the trader for being busy. It compensates him for being right. By treating waiting as a legitimate and powerful position, the professional aligns himself with the market's rhythm rather than fighting it. In doing so, he learns a fundamental truth of speculation. Profits are not made by constant action, but by well-timed action preceded by intelligent waiting. The fifth and concluding principle is that selective engagement preserves both capital and confidence. The market is not a place for constant participation, it is a place for measured commitment. The professional operator does not seek excitement, nor does he measure success by the frequency of his trades. He measures it by the quality of his decisions and the preservation of his resources, financial and psychological. The public trader is always involved. If not long, he is short. If not trading, he is searching for a reason to trade. This continuous exposure erodes capital through commissions, slippage, and poorly timed entries, but more damaging still is the erosion of confidence. Each marginal trade introduces uncertainty. Each small loss creates emotional residue that interferes with the next decision. Over time, this cycle leads to inconsistency and self-doubt. Selective engagement breaks this cycle. By choosing when not to trade, the operator protects his capital from unnecessary risk. He understands that capital is finite and opportunity is selective. Every trade must justify its existence by offering a favorable balance between risk and reward. If such a balance is absent, no trade is taken regardless of how active the market appears. Confidence, like capital, must be preserved. It is built through disciplined execution and reinforced by logical outcomes. When trades are taken only under confirmed conditions, results, whether profitable or not, make sense. Losses are accepted calmly because they occur within a rational framework. This clarity strengthens confidence rather than damaging it. Selective engagement also sharpens the trader's perception. When fewer trades are taken, each one receives greater attention and preparation. Records improve. Errors become visible and learning accelerates. The operator becomes increasingly aware of which conditions favor his method and which do not. This refinement is impossible for the trader who is constantly in the market. Another advantage of selective engagement is timing alignment. Markets move in waves, not in straight lines. The professional waits for moments when structure, behavior, and confirmation converge. At these moments, price moves with less resistance and greater follow-through. One well-timed position taken under such conditions can outweigh numerous poorly timed trades made in uncertain environments. It must be clearly stated that selective engagement does not reduce opportunity, it concentrates it. The operator is not missing trades, he is avoiding low-quality risk. By doing so, he ensures that when he does commit capital, he does so with authority and conviction. In the final analysis, the professional trader survives and prospers not by outworking the market, but by outweighting and outselecting it. Capital preserved becomes capital multiplied. Confidence protected becomes confidence compounded. Through selective engagement, the operator aligns himself with the true rhythm of the market, acting decisively only when the odds are demonstrably in his favor and remaining inactive when they are not. In conclusion, the central lesson of this discussion is both simple and demanding. The market rewards judgment, not activity. To trade successfully, one must abandon the illusion that constant involvement produces consistent profit. Most price movement exists to distract, to test patience, and to transfer capital from the impatient to the prepared. The professional operator survives by learning what to ignore and when to act. By recognizing that not every movement is an opportunity, observation becomes selective rather than compulsive. By observing with purpose, the trader studies structure and behavior instead of reacting to noise. By waiting for confirmation, he replaces opinion with evidence and hope with probability. By treating waiting as a valid position, he preserves capital and mental clarity. And by engaging selectively, he protects both confidence and resources for moments of true advantage. These principles are not shortcuts, they are disciplines. They demand patience, restraint, and trust in process. Yet it is precisely these qualities that separate the consistent operator from the perpetual participant. The market will always offer motion, excitement, and temptation. It offers profit only to those who wait for clarity and act with intent. In the end, successful trading is not about seeing more, it is about seeing correctly. Not about acting faster, but about acting at the right time. Those who learn to watch less, wait longer, and act only when the market confirms its hand will find that consistency is not found in activity, but in disciplined restraint aligned with market truth.